Welcome. I know that intermediate accounting can be very intimidating. Now, if you've suffered through Intermediate Accounting 1 and felt confused, you're likely going to be very worried after reviewing the first chapter in Intermediate Accounting 2. There are, by my count, 19 different liabilities discussed. No wonder it feels overwhelming. But here's the good news. It really is manageable. Students often concentrate on all those different liabilities that are presented in the chapter and then try to memorize the journal entries. That's completely the wrong approach. You already know how to prepare journal entries. Well, at least you should. If that's a weakness, you need to work on it, not just for success in this course, but for your future accounting or finance career. The primary learning objective, what you should better understand at the end of this chapter, is how to determine whether there is a liability. See, in your introductory accounting courses, you focused on how to record transactions as they occur. The focus in intermediate accounting is financial statement preparation. So mentally, you have to consider the past activities at the reporting date. And we can think about this as year end, although corporations may be required to report more frequently. You need to then decide if there is a liability that needs to be recognized, included in the statement of financial position, at the reporting date. Now, since Intermediate Accounting 2 focuses on liabilities, most questions that you're going to encounter will expect you to identify the liability and then use an appropriate measurement tool. And sometimes measurement's very easy. The focus of this chapter, and most of the chapters to follow, is on those liabilities that require a bit more work to measure appropriately. Now, I know you've already reviewed the material from Intermediate Accounting 1, so you remember to recognize an element when it meets the definition of the element, is probable, and is reliably measurable. And the characteristics of a liability, because that's the element we're focusing on, the characteristics of a liability are they represent a present duty or responsibility. The duty or responsibility obligates the entity, leaving little or no discretion to avoid it. And the transaction or event results from a past transaction or event. In other words, it's already occurred. So I want to quickly examine some of the common liabilities that are covered in this chapter using that filter. Let's take a look at bank indebtedness. So what you think about is, does the entity have a present duty to repay a bank or other lender? Is it a binding obligation? Did the obligation exist at the reporting date as a result of a past transaction or event? If you say yes to these questions, then you need to determine the appropriate measure and classification. Is it current or non-current? Then you focus on the best measure. This is it. Here's where we will have our difficulties. This is where substance over form comes in. And this is so that we can satisfy the requirement that financial statements reflect the economic reality of the transaction. I'll give you an example. If the entity purchases equipment right near the end of the year, and the invoice says the equipment cost $100,000, and they don't have to pay for it for 5 months. Is there a liability? Well, I think most of you would say yes, there is. They have to pay that money. So if the creditor charges 3% interest, and that's only due when the loan is paid in 5 months, is there a liability for unpaid interest? I think you're familiar with that concept and would say yes. But what if the creditor says there is 0 interest on the loan? Now, how do you measure the liability? Let's take a look at dividends payable. So does the entity have a present duty to pay dividends to the shareholders? Is it a binding obligation? And did the obligation exist at the reporting date as a result of a past transaction or event? If the entity has declared a dividend but not yet paid it, then it meets the criteria of a liability. Remember, the duty must bind the entity. If not, then don't recognize the liability. Preferred dividends in arrears are not a liability. See, the entity might never declare a dividend, so it's the declaration of the dividend that is the event that creates the binding obligation. Let's take a look at another example. What about customer advances and deposits? So when the customer gives the entity money, does the entity have a present duty to the customer? Is it a binding obligation? Did the obligation exist at the reporting date as a result of a past transaction or event? And I think you can see that in this case, it's pretty simple. The answer is yes. But for a fun, thought-provoking exercise, take a look at the case called Kickstarter on Blackboard. And then there's taxes. The answer to the question that we ask is yes. And the statement of financial position will recognize the liability for taxes that have not yet been paid. Now, the textbook starts to give a short overview of how the taxes are collected and paid, and I've also covered that in the lesson notes in Blackboard. But that's just to help you understand the mechanics behind it. If they haven't been paid, then we have a liability. Employees bring with them a lot of additional costs. For example, during the year, various amounts have been withheld from employees' paychecks for things like CPP, EI, federal and provincial taxes. Again, the textbook gives an overview of how these are calculated and withheld, and I've covered that in Blackboard as well. And these amounts are due to the taxation authority, along with any corresponding obligation for contributions by the employer. Now, we know that wages are usually a period cost associated with the earning process. And as a result, if the employer owes money at the reporting date for workplace safety insurance, union dues, health insurance based on wages, then these amounts represent both a current expense under the matching principle and a current liability. The entity has a responsibility to remit these amounts to the proper parties and has no discretion to avoid this. And the obligation is the result of having had employees during that time period. That was the past activity. So I think you're starting to get the idea now. Yeah? I want you to think about whether each of these results in a liability and why. Buying an asset that obligates you to incur costs in the future when the asset is retired. You're not going to have those costs until you're finished with the asset, until it's done. So does that create a liability at the financial statement reporting date? The past activity that triggers the liability is the fact that you purchased that asset with that responsibility. So the textbook then describes how we account for that debt retirement obligation. Asset retirement obligation. Debt retirement's a whole other story. How about if you make a sale with a guarantee to replace or repair the product for a specific period of time? Do you have a liability at the financial statement reporting date? And if so, how much? How about you make a promise to your customer that if they buy 10 coffees, they get one free? Is that a liability at the reporting date? Does your answer change if the promise is to give a free big screen TV if the customer buys over $5,000 worth of product in a year? Here's another one that's quite common to many businesses. What if a customer falls in your parking lot and their lawyer sends you a notice of their intention to sue for damages? There's a lot of unknowns around here. The past activity, well, the person did fall. The lawyer has sent you a letter expressing their intent to sue, although they have not done so. And of course, if they do sue, you have no way of knowing how much you will ultimately pay out on that lawsuit. Maybe you'll settle it out of court, or maybe you'll incur all sorts of costs and ultimately a big payout. So with all that uncertainty around it, how do you ensure that your financial statements at year end include the liability? So the question is always to look for the liability and then determine how to measure it. And then you have to think about whether additional information should be disclosed in the notes so that the users can make good decisions. Thankfully, the CPA handbook often provides fairly specific instructions, which we'll cover in the textbook. And whether or not it's covered or a more general provision, it often seems logical and reasonable. See, the journal entry is the last thing you think about. I hope that helps. In any regard, keep calm and carry on. Thanks very much.